Barbara Heggie. I'm the coordinator of the Low Income Taxpayer Project, and I'm also one of its 2 staff attorneys.
And I'm meteorologist, I'm saying meteorologist Mike Cameron. Actually, I'm also an attorney. I also currently work on the side as a meteorologist, but my new career is as a meteorologist and also helping out with the Low Income Tax Project. And so that's why I'm here in this show.
And I'm so glad that Mike was able to join us because he has experience with TV
Obviously
and,
not.
and the law. And he has kindly volunteered to help out with one of our clients already at the tax clinic. Before we get started on today's topic, which is the Earned Income Tax Credit, I want to say a little bit about the Low Income Taxpayer Project. It is a free clinic for low and moderate income people who have problems with the IRS. We don't do current year tax return preparation, so if you're looking for help to get your taxes done, that's not something that we do. You can call 211 to find a free tax return preparation site near you, such as a VITA site or an AARP Foundation tax aid site. What my clinic does is help people who have problems with the IRS over past years. For example, if they're in collections and they're facing a lien or a levy and they're not sure what to do, they could call my clinic, and there'll be some information up on your screen to tell you how to get in touch with us. Also, if you're facing an audit, for instance, if you claimed the Earned Income Tax Credit and the IRS sends you an audit notice, then you could call us for some help with that. Also, some people have problems with worker classification issues. Yeah. Perhaps they're being treated as a self-employed person when they're actually an employee. And also some people might have trouble with innocent spouse issues. These are all things that my clinic can help with. And just as an example, if you're wondering, well, how low does my income have to be to allow me to get these free services, we go up to 250% of the poverty line.
Which is today, and what's that roughly?
For a family of 4, that would be $61,500.
Wow. Wow.
So we cover a lot of people. For a family of 2, that would be $40,600. Okay. Yeah. And I just want to say that in addition to representing clients who are in need of services with their IRS controversies, another mission of our clinic is to educate about different tax rules and laws, and that's why we're here. We want to talk about the Earned Income Tax Credit. Also, I want to emphasize that my clinic is part of the pro bono referral program at the Bar Association, and so we can turn to volunteers such as Mike to help with some clients if we're not able to take care of them in-house, and that allows us to help even more clients than we might have otherwise. So let's get started with the Earned Income Tax Credit. So the big question is, well, why are we here talking about this, Mike?
Because it can be really, it comes down to a lot of money.
Yeah,
I mean,
absolutely.
We've all, at one point in our lives, probably have had some refund come back.
Yeah.
And so that's essentially why this matters. We're going to go to a slide, and we're talking about money that could be in the thousands of dollars. Even if you only make a little bit of money, you could be talking about several $1,000s coming back to you from the IRS. For instance, if you're earning about $15,000 and you have a child which is a qualifying child, and you're going to be talking about what that is in just a little while, because child means something different to the IRS.
Right, the IRS has its own dictionary.
We'll talk about that in a second. But if you're that person, you could be eligible for $3,300, actually $3,373 to be exact. Maybe you're somebody who earns between $15,000 and $20,000, and you have 3 qualifying children. You could get $6,000 back from the IRS.
That's right. Yeah, and this is in a refundable credit, and that means that even if you owe no taxes, you could still get this as a refund coming back to you if you file a tax return.
So in other words, that's money that you really even never paid out to the IRS in the first place.
Right, yeah. It's not just getting back whatever was withheld from your paycheck. This is something in addition that you can get to put in your own bank account.
So that's pretty important.
Yeah. So I just want to point out too that if you earn less money than that or more than that, you still might get some earned income tax credit money, just not as much. It tapers off on either side.
Right.
Yeah, the idea is to, the idea from Congress, which enacted this particular provision of the Internal Revenue Code, the idea is to help out people who are working full-time but just aren't earning very much and really need a little extra. And so if you're working, for example, full-time at a minimum wage job, you're going to be below the poverty line. If you've got one or more child with you, then this money from the earned income tax credit can bring you up above the poverty line.
And this is something that has been around for a while.
Yes.
Back past Reagan, back to the Ford administration.
That's right.
And it's something that I guess a lot of people like, just because it's a different way of actually helping families out, where it's through the tax program and it's not necessarily having to necessarily go and seek out help.
Exactly.
It actually comes through your own finances, which is a nice way to do it.
Yeah, yeah, and the fact that it's tied to your earnings makes it seem different than some other sorts of benefits that you could get if you are in need of some assistance. And so it has had a lot of bipartisan support over the many years, and as Mike said, it got started in the Ford administration and then was greatly expanded under Ronald Reagan's administration. Yep, so now we're going to go to another slide that gives you more information about the amount of money that you might be able to get with the earned income tax credit depending on your income. Now, as you can see on this chart, if you have no qualifying children, the most that you can get in earned income tax credit is $506. Obviously not as much as if you have qualifying children. For 3 or more children, you could possibly get as much as $6,269. But still, $506 is nothing to sneeze at, especially if your income is low. And you can see also on the chart that the more children you have that qualify you for this credit, the higher your income could be before there's no possibility. When you look at the chart and you see that number 6,269, that looks pretty good. Just keep in mind that that would be for families with an income range of between about $15,000 and $20,000. The $53,505 cutoff is just that. It's a cutoff.
Okay.
At that point, if you were making $53,000 and you had 3 or more children, you would just get a few dollars in the earned income tax credit. That's how it works.
Okay.
Yep. So,
and there are a lot of people that actually miss out on this.
Yes, that is so true. If people claim this credit, it can do a huge amount of good for a family that's really struggling, and that's the whole point of it. And for example, during 2015, about 27 million people received some earned income tax credit, and a total of $65 billion for 2015 was handed out to people, not through a welfare office, but as a refund check from their tax return.
For your own hard work.
Yes, for your own work. Yes,
if you have children and you're working and you're making $15,000 to $20,000 a year, you need help.
It's yeah.
And it's awesome.
Yeah.
Awesome.
Yeah, the average amount for that year was $2,400.
That's great.
Yeah. So together with the child tax credit, another credit available to people with children, the earned income tax credit has lifted 9.4 million people out of poverty.
Now that's among, there are 5 or 6 different credits that can be...
different tax benefits that are available for people who have children, and so that's something to keep in mind. And if you have more questions about some of the other child-related tax benefits, feel free to give me a call.
Yeah.
we can talk about that. Or if you get your tax return done at a VITA site or an AARP Foundation tax aid site, the people there can help you about that too. Yeah, and so one of the reasons why we're here is because so many people do miss out on this.
20% actually is the figure that we have.
Yeah.
And that's considerable when you think about it. It's especially we who are among those 20% absolutely could use the help. And it's just a matter of you have to file the return in order to get the benefit.
That's right. That's right. And so what we want to do here is go through some of the basic rules for getting this earned income tax credit, and then we'll go through some of the more common myths that people have that are preventing some people from getting this credit that they are actually entitled to under the laws of, from the Internal Revenue Code that Congress enacted to help people.
So we'll go to this next slide, and these are the rules that apply essentially to everyone. You need to be valid for work. You must be valid for work and have a Social Security number. You can't be married filing separately. Tell us a little bit about what that means.
Yeah, so there are several different filing statuses possible. There's single, head of household. There's married filing jointly, married filing separately. Also, a qualifying widow or widower. I want to emphasize that if you're married, you don't have to file jointly. A lot of people don't realize that. There's no rule that says you have to file jointly if you're married. But if you file separately, there are many benefits under the tax code that are not available to you, and one of those is the earned income tax credit. You can't get the earned income tax credit if you file as married filing separately.
And then no foreign earned income, meaning that it needs to be earned in the U.S.?
That's right, yeah.
Okay.
Yep.
Okay. We've also got no more than $3,450 in investment income, and investments includes
stocks and bonds, capital gains from that, or dividends and interest, that sort of thing.
And earned income. And the word earned, according to the IRS, has a slightly different connotation than we would think.
Yeah, earned income as defined by the IRS does not include Social Security. It does not include unemployment income, child support, alimony, and no public benefits either.
But some people would claim that, well, I earned that money.
Right, yeah, but the
Especially
IRS...
Social Security.
I know.
We put our money into that, so the IRS doesn't see that as earned?
Not for purposes of the earned income tax credit.
Okay, only that.
Right.
All right, not qualifying child of someone else.
Yeah.
Meaning that you can't go to your neighbor's house and say, hey.
Yeah, and also if you could be the qualifying child of, let's say, an older relative, then you can't be claiming.
So if you are actually the qualifying child for somebody else's return. Okay.
Yeah. Okay. And we'll get into the definition of child in a minute.
All right, a U.S. citizen or a resident alien for an entire year. That's the final
that's right.
for everyone qualification for these rules.
Yep. Yeah, so let's now go to the next slide that shows the rules for claiming the earned income tax credit when you want to claim a qualifying child. As you saw earlier, this is where the big dollars come in. You're able to get a lot more in earned income tax credit if you're able to claim a child. So again, the IRS has its own dictionary. So when you think of a child, it's not necessarily your child. It could be the child of your child. So in other words, it could be your grandchild. It could be a grandniece. So the first part of the definition has to do with relationship. The qualifying child does not have to be your biological child. It could be your adopted child or a foster child. It could be a stepchild. And it could be the descendant of any of those. so a grandchild, for example. Also, it could be your sister or your brother.
You were telling, when we were talking about
Yes.
before the show, we were talking a little
Yes.
bit about a scenario, and I really like this one because it really does
Yeah.
illustrate what you mean by that, when it could actually happen.
Right. Again, don't think that child necessarily means what you and I would think of as a child. So, for example, if you were 22 years old and you were married to someone who is 24, and you have a brother who is 23 and still a full-time student, if you're filing jointly with your spouse, that brother of yours is younger than your spouse, and so that that brother of yours, if all the other rules of the Earned Income Tax Credit apply, can be claimed by you on your tax return as a qualifying child for the Earned Income Tax Credit. So don't assume that someone is not eligible to be a qualifying child just because it's not a little kid going to grammar school, running around outside and causing havoc here and there. And also it could be the child of a brother or sister, so a grandniece, a grandnephew.
But there are age restrictions.
Yes, that's a little bit more clear-cut, or maybe a little more obvious, I should say. There is an upper age limit unless the person you are claiming for the credit is permanently and totally disabled. Then it doesn't matter how old the person is if all the other tests are met. So if not permanently and totally disabled, the person would have to be younger than 19, so up to age 18, unless the person is a full-time student, and then you can go up to age 23. And full-time student means, yeah, and for at least 5 months during the year. Yeah.
Residency, in my helping out with the low-income tax program, this is an important thing in looking at the Earned Income Tax Credit in terms of audit and when they're actually proving it. So residency is an important thing.
Yeah, that's absolutely right. If you do get audited for the Earned Income Tax Credit, first of all, don't panic. It happens to a lot of people.
It's automatic by computer.
Yeah, there are random audits that will have nothing to do with your situation. So don't think that you did something wrong just because you're getting audited. And my clinic can help if you feel like you need help. So the thing to keep in mind with residency is that the person you're claiming as a qualifying child has to have lived with you for a majority of the year. And the way the IRS would calculate that is by the nights where the child is staying. And most years have an odd number of days, 365, and so if it's between two different parents, there will be one parent, except for in a leap year, who will have the child with them for a majority of the nights.
183 nights.
Right, yeah. And
but what if Johnny goes to friend Susie's house for a couple nights?
Very good question, and also going away for school or camp or something like that. Where the child would have been if it weren't for that sleepover or that camp or school, that's where you start counting the days. Yeah, and one last thing about these requirements. If your qualifying child happens to be an adult who is married, for example, in our scenario, what if your brother is married and both spouses are living with you? It still could work so long as the two of them don't file a joint return, unless they're only filing the joint return in order to get withholding back from their paychecks from the previous year. So as you might have noticed, there are a lot of rules, a lot of exceptions. Feel free to ask for help if you need to.
And that's what we're here for.
Yeah. So now we're going to turn to the next slide.
Yep, and that's when not claiming a child, and that's we still can get at least a little bit of earned income tax credit, as you were saying
Right.
before. What was the number?
506 is the maximum.
$506,
Yeah.
and these are easy. I think, in generally speaking, you've got to have lived in the United States for more than half the year. You need to be between, or at least 25, but less than 65. So that's generally working age. I think that's
Yeah.
what that comes from. And again, you can't be a dependent of another person, as we were talking about before.
Right.
So.
Yeah. But one thing to keep in mind for the earned income tax credit, you don't have to show that you supported the child while they were living with you. This is different than the dependency exemption, for example. So we're going to turn now to the myths that we want to bust about the earned income tax credit. And
I play the foil.
Yeah, Mike has agreed to be the one who is listing all these myths that are trying to say that he can't qualify for the earned income tax credit.
But these are pretty common questions that I think a lot of people
Yeah,
have. I mean,
absolutely.
we've thrown a lot of information out there, but when you distill it into these, I think this might help you. You might find at least some similarity to your life. So we'll see how this goes.
Yeah.
Myth number one, I don't make enough to file a return, so I can't get the earned income tax credit.
No, that's not true. No. You can file a return even if you don't have to. You don't have to file a return if you have wages under $10,300 and you don't have any other kind of income. But as you saw from those charts, you might still be able to get some earned income tax credit money if you earn less than that. But you can't get the credit unless you file a return.
So the IRS still knows you're out there. So you're not hiding it.
Yeah, and the earned income tax credit kicks in starting with $1 of income.
That's amazing. All right,
Yeah.
here's the next myth. I don't have any children of my own living with me, just grandkids, so I can't get the earned income tax credit.
No. So as we were saying before, it is possible to get some earned income tax credit money if you have no qualifying children at all, if you meet the other requirements that we listed. Not as much as if you had children, but you could still get some. Also, if you just have grandchildren, well, grandchildren could be qualifying children. Remember that the IRS has a dictionary very different than ours, and their definition of child is different than our definition.
Absolutely. Okay, the next myth. My ex claims the kids as dependents, so I can't get the earned income tax credit, even though the kids live with me most of the time.
No. The IRS doesn't require people to have all the child-related tax benefits together. It is possible to separate some of them. So, for example, one parent can claim the children as dependents for the dependency exemption, even if the children aren't living with them. If that parent fills out a special IRS form, it's Form 8332. You don't have to remember that. You could call me if you need to get that, or Google it. But the earned income tax credit can only go to the parents who have the children staying with them the majority of the year. And so it is possible for one parent to claim the children as dependents, and the other to claim the children for the earned income tax
But
credit.
they will have taken special steps in order to do that. You will have
Yes.
known that you've done that.
Yeah.
Okay. Here's another myth. My daughter started college last fall, and she's already 18, so I can't claim her.
No. No. As we said before, the rules are a little different if you have a child who is a full-time student, and so you can go up to the age of 24, just until the 24th birthday, if the child was a full-time student. And again, if the child was permanently and totally disabled for the year, then it doesn't matter how old they are.
Okay. The next myth. I can get the earned income tax credit because of my summer job, even though I'm in college and my parents claim me on their return. I don't have a kid.
No,
No,
sorry.
all right, you lose that time.
Sorry, I found this out when I was helping out my college-age daughter with her tax return. No, the rules are very different when you have no children. If you can be claimed as a dependent on somebody else's tax return, such as your parents, then you cannot claim the earned income tax credit for yourself, and you have to be at least 25 years old and under age 65.
Okay. All right, the next myth. I don't want to lose my food stamps. If I get the earned income tax credit, I may not qualify anymore for public assistance.
No, it doesn't work that way, thank goodness. Most of the time, it does not count towards the income limits for federally funded public assistance. But it's still a good idea to just check with let's say the State Department of Health and Human Resources or your town welfare office if you're receiving some assistance from them, just to be on the safe side.
All right. The next myth, I can't get the earned income tax credit because my ex and I have joint custody of the kids.
No. And we talked about this earlier. It is possible to split the benefits for the earned income tax credit. All that matters in terms of residency is, was the child with you for a majority of the year? And the IRS doesn't much care what the divorce decree says.
Okay, yeah, you need that form.
You need that form
or
to split the benefits to have the non-custodial parent take the dependency exemption. But for earned income tax credit, you just need to show that the child was with you for a majority of the time.
I didn't work last year. This is the next myth. I didn't work last year, but I can get the earned income tax credit based on my alimony payments and child support and unemployment, right?
No.
Okay.
No. Unfortunately, the definition of earned income does not include any of that. Earned income is generally speaking wages and net self-employment. Those are the two major categories.
Here is the next myth. I won't get much earned income tax credit this time because I was deployed in Afghanistan last year and my combat pay is non-taxable.
Fortunately, I can say no to that also. For people in the military, it is possible to have your combat pay counted towards the income for earned income tax credit. You get to decide which way you want to do it. Whichever way comes out better for you, that's the way you can do it.
Because you are counting that as taxable income at that point. Is that why
right,
there are
yeah.
some cost benefit analysis that you need
yeah,
to do?
so it's possible that you would come out better overall if you don't include it as taxable income. But if it turns out that it would be better for you to include it so that you can get the earned income tax credit, then you're allowed to go ahead and do that.
All right. Here is the final myth we've got for you today. The earned income tax credit is way too complicated. I can't possibly figure it out.
Well, yeah, it is complicated. I'm not gonna argue with you there. But you can figure it out. You can figure it out on your own with a little research, or by asking for help. You can go to your local VITA site or AARP Foundation Tax Aid site to get help with your tax return. Or you could give us a call. Give me a call. He's a volunteer. He's in private practice, so I wouldn't call him directly. And just make sure that that you never assume that you're not eligible for this just because you've heard some myth floating around. And we thank you very much for your attention, and we hope that you've gotten some of these myths busted.
All right.
Thanks.
And we very much thank you for joining us, and we hope that some of this information is helpful.
Yeah.